Moving on with the interest-sensitive gap, ISG, there are three ways to measure the IS gap. All right. First is the dollar IS gap. Okay, and so that is interest-sensitive assets. It's the dollar value of interest-sensitive assets minus the dollar value of interest-sensitive liabilities. For example, let's say a bank has $200 million in interest-sensitive assets and $150 million in interest-sensitive liabilities. So the interest-sensitive gap is the, gosh, this got flipped. 200 million minus 150 million, which is 50 million, okay? Which, this would mean that this bank is asset sensitive, okay? Which means that rising rates would be good for the bank, falling rates would not. Now, if it was flipped, it was 150 in assets and 200 million in liabilities, okay? Then it would be minus 50 million, the bank would be liability sensitive, and interest rates going down would be good for the bank, bad if they went up. All right, given any specific change in market rates, we can calculate approximately how much net interest income will be affected by a change in interest rates, okay? So, and that's an interesting number. As we're looking at the bank, we're saying, what happens if rates change, okay? So the change in net interest income is equal to the percentage point change in rates times the dollar amount of the IS gap, okay? For example, interest-sensitive assets, 200 million, interest-sensitive liabilities, 150 million. The interest rate goes from 5% to 6%. The dollar change in net interest income is 200 million minus 150 million, which is the interest-sensitive gap, 50 million, times 1%, which is 500,000. So net interest income will change by 500,000 for this bank in this position. Okay? So you start to get a sense of how we can forecast and model the bank and control risk. Do we want this $500,000 to happen either positively or negatively, because interest rates could move up or down? So we have to decide how big we want this gap to be. All right. Then we have the relative IS gap ratio, which is the dollar amount of the IS gap divided by total assets. And that helps us compare different size institutions. Okay? So if the relative IS gap is greater than 0, the bank is said to be asset sensitive. If the relative IS gap is less than 0, the bank is said to be liability sensitive. Okay? In the previous example, the relative IS gap is 25%, and so this bank is asset sensitive. And then lastly, we have the interest sensitivity ratio, which is the dollar amount of interest sensitive assets divided by the dollar amount of interest sensitive liabilities. It's a very similar way of computing it. If the ISR is greater than 1, that means this is higher than this. The bank is asset sensitive. If it's less than 1, the bank is liability sensitive. And we know what happens. Once again, asset sensitive, interest rates go up, good. Interest rates go down, bad. Liability sensitive, interest rates go up, bad. Interest rates go down, good. You have to know that. Keep that in mind. In the example, the ISR, 200 million divided by 150 million, is 1.33, greater than 1. This bank is asset sensitive. All right. A complicating factor related to gap analysis is time. We measure the gap for different periods of time, not just for one period of time, because assets and liabilities have maturities. And they have dollar amounts invested. So time matters. Okay. The gap will change depending on the time frame that you are using. You have to group assets and liabilities based on different time periods. Okay? We're going to look at a table. So here's our table. So we have maturity buckets. 1 day, 2 to 7, 8 to 30, 31 to 90, 91 to 120 days. This is the amount of asset-sensitive assets for each time period. And this is the amount of interest-sensitive liabilities for each time period. So we have to match these up to see what the bank looks like. And we have to have a cumulative amount to see if the bank overall is asset-sensitive or liability-sensitive. So it could be a situation where for one period of time the bank is asset negative or positive, for example, for one period of time, but asset negative cumulatively. Let's take a look. Okay? So the bank is asset sensitive for all periods. So for each period, plus, 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 except 2 to 7, minus 40. Okay? The dollar gap is negative. The dollar negative gap is so large for 2 to 7 days that it causes the cumulative gap to be negative here in the next period, even though the period is positive. And even though 2 of the 3 periods are positive, this period of negativity is so large that it keeps the cumulative gap negative. Okay? All right. And then what you can see is that through 120 days, this bank has a positive gap. Okay? Interest sensitive. So once again, we have to drill deep. We start with a simple concept and then we add reality to it. All right. There are many gapping methods out there, but all methods require managers to make these important decisions. 1, choose your time frames or your maturity buckets. Weeks, months, quarters, 6 months, a year, 2 years, 5 years. 2, choose the target level for your net interest margin. The net interest margin for most banks is around 3.5%. Okay? You have to choose that target. Take action to protect that target margin through some combination of the dollars that you have invested in assets versus liabilities and the yields that you can earn on assets and the yields that you pay on liabilities to close that gap. Now that you understand the gap, you have to take action with your maturities, with your liabilities, with your assets, with your yields, in order to close that gap. The wider the gap, the more volatile your profitability is going to be. All right. There are problems with interest-sensitive gap management. It is not always straightforward. Often the interest paid on liabilities tend to move faster than the interest rates earned on assets. This is because liabilities are short-term, assets are long-term. So short-term securities tend to move, the rates tend to change faster than long-term. Okay? The rates earned on bank assets and the rates paid on bank liabilities do not move at the same speed as market rates. That's another problem. So rates may change in the market, but not necessarily on bank assets and liabilities as fast. Okay? And that creates a problem. And then determining when assets and liabilities will be repriced is not always a straightforward exercise. These are very complicated techniques that require really solid data systems and programs. Okay? All right, so these are some problems with gap management. All right, so let's take a look at some common actions or strategies that management will take. If you have a positive gap, which means you are asset sensitive, okay, the risk is that rates will fall, and that will impair the net interest margin because yields on assets decline more than the cost of liabilities because assets in this portfolio reprice faster than liabilities. That's with a positive gap. The goals are to keep yields on assets from falling. Okay? When you have a positive gap, you're asset sensitive. Okay? You want to shrink that gap. How do you do that? You want to lock in your yields on your assets, and you want to make your liabilities more repriceable. Okay? So that their costs will fall as rates decline. So you want to try to make asset yields stickier, and you want to make liability yields more flexible, more mobile. So the actions to do this are add more dollars into fixed rate loans to make them stickier, or longer term securities to slow down repricing. Okay? Add dollars into securities with longer maturities to slow repricing. Reduce dollars in short-term securities, sell your short-term securities and buy longer-term securities to slow down repricing. You're trying to slow the repricing of assets and speed up the repricing of liabilities. Extend renewal periods on floating rate loans. Okay, tell your customers, we're not going to renew in 6 months, we're going to renew in a year. And reduce repricing periods on repriceable liabilities. Okay? As interest rates are falling, you don't want you want to reprice what you're paying as often as possible to protect your margin. All right, that's with a positive gap. Now with a negative gap. The risk is that rising rates impair the net interest margin as the cost of liabilities rises faster than the yields on assets because the liabilities reprice faster than the assets. So if market rates go up, you have to pay a higher yield on your deposits. But your assets won't reprice, they're still locked in at the lower rate. Bam yow goes your margin. Okay? The actions related to this are add dollars into floating rate loans. Now you want to speed up the repricing of assets. So you put more dollars into floating rate loans or shorter term securities to speed up repricing of assets. Shorten renewal periods on floating rate loans. Instead of a year, 6 months, so that you can reprice at the higher returns, higher yields. Add dollars into securities with shorter maturities to speed up repricing. So here, you're doing the opposite. When you have a negative gap, that means that your assets do not reprice as fast as your liabilities, and you want to speed up the repricing to close the gap. Okay? So you do everything you can to speed up the repricing of assets and to slow down the repricing of liabilities. So reduce dollars in longer term securities, speed up repricing, and extend repricing periods on liabilities. When rates are going up, you want your assets to reprice quickly at the higher rates, but you want your liabilities to reprice slowly so that the cost of liabilities won't go up. All right, that is the end of that particular section, the section of managing the gap, interest rate sensitive gap, managing your net interest margin. Now we're going to shift over to the other goal, which is to protect the owner's equity of a bank. And we'll do that in our next clip. Peace out. Shalom.